For those of you that are catching this intro, Tim and I just had a conversation for 10 minutes with the live showing up on the top left corner, only to find out that it was loading. So
for 10 minutes.
You're catching us in a bad mood because we thought we just had this thing going, and
we were rolling.
We were rolling, and we were not actually rolling.
Oh, all right.
So anyways, guys, it's good to be with everybody. Chris Litzler, Marcus Millichat here in Cleveland, Ohio.
So
thrilled to be with my boy.
Don't know Chris. Chris is a dear friend of mine and has been banking and handling all of our debt placement and all of our loans since almost since I started. Since I started doing big deals. When I started getting over 50 units and bigger, Litzler banks all of our stuff. So he's a commercial mortgage broker out of Cleveland. His shop got bought out by Marcus & Millichap, which is one of the largest brokerages in the country. And he is seen as one of the foremost authorities in the entire country in the mortgage markets. And so they have him speaking on panels and all sorts of different stuff. And the guy's placed over $1 billion himself of loans and mortgages over the past handful of years. So couldn't be hearing this from a better expert. And Christopher, I appreciate you being here, brother.
Always a pleasure. It always feels like whenever we get to do something like this, it's never the rosiest of conditions.
No.
You know, it's never like
things are going good, nobody cares.
It's never, that's exactly right. No, it's never like, oh, everything's great, leverage is abundant, a lot of IO. It's always something's going wrong. But that's great.
It could turn into opportunity though.
You're right.
So let's give a backstory again of what's been going on in the market. So for those of you who are kind of aware, not fully aware of what's going on, there's been a lot of discussions, turmoil, phone calls, craziness going on in the capital markets, the financial markets right now. And let's just go back to last week. Last week, a rumor popped up that a bank on the West Coast, a pretty large regional bank named Silicon Valley Bank, was insolvent. And that means they don't have enough cash on hand. And essentially what happens is, and Silicon Valley Bank grew like crazy. They grew since 2020 because they bank a lot, they're in Silicon Valley, so they bank a lot of the tech companies that have all boomed since COVID hit. And their deposits, meaning people like you and me putting money in the bank and businesses putting money in the bank, has grown to like $200 billion, like 4x, 3 or 4x or something over the past like 3 years alone. So they got all this cash and they put a bunch of the cash into mortgage-backed securities and some other stuff. And, because they don't just hold on to it. They lend it out to other businesses. They lend it out to on real estate. They lend it out to growing companies, anything that you could imagine, they're lending money out on. So they don't have $200 billion of cash. So when this rumor appeared last week that they were insolvent, a whole bunch of people went to the bank or jumped online and tried transferring money out on Friday. They had over $43 billion attempted to be pulled out of the bank on Friday alone in a single day. And they obviously don't have that cash. So they had to close down, and federal government came in and essentially the stock price started going like this. And then boom, it's not worth anything. The bank's not worth anything because they're seen as insolvent. And I had given an analogy for anybody who's ever seen the movie It's a Wonderful Life, the Christmas movie. It's the #1 Christmas movie ever, right? And so in that, George Bailey, the main character, runs a savings and loan, and there's a run on the bank during that time, during his when he owns that bank, and everybody knocks on the door and they're like, I want my money. And he's like, listen, I can't give you your money back because it's in Sally's house, and your money, Bill, is in Philip's house, and like he's got the money deployed in other assets. And so when people try to come and get their money, it's not good if they pull out all their deposits, because then there's no liquidity in the bank. And that's what happened with Silicon Valley Bank. And so that bank goes bankrupt by the end of the day on Friday. Federal government steps in, takes over operations, and but there's this ripple effect, and there's this fear in the market, and all of a sudden another bank, Signature Bank, which is a big bank out of New York City, and a lot of different companies utilize them. They invested very heavily in the crypto markets, and And obviously when crypto got hit pretty hard last year, a lot of their deposits went down. And so they were a little bit more, I don't know, susceptible, I guess, to something like this happening. And so there's a bank run on them. They end up getting wiped out. Federal government steps in, seizes all their assets. And then we come to this morning, right? So this morning, things are so chaotic over the weekend. Biden hops on the TV and makes an announcement to the public and talks about how why this happened, right? And what's happened over the past 3-4 days, and what the government is doing right now in order to protect all the depositors. And so he says that everybody who's got money in either of those banks is taken care of. So like there's the FDIC, right, that guarantees any deposits up to $250,000. But what happens if you got more than that? What happens if a company or a tech company or a crypto company has $600 million? Well, it's not secured, but Biden and the administration is saying that it is. They're also saying that it's not going to be the taxpayers like you and me, federal taxpayers, who are paying for that. They said it's going to come off of fees that are paid in by all the banks into the FDIC to make sure something like this happens. Now, what happens if a ripple effect occurs? Does it still adversely impact deposits? Are all bank deposits at all banks going to be secured? Not unlikely. So, but he's trying to, calm everybody down, make sure that they know that, these are isolated events. And Signature Bank is saying, hey, we were totally fine until there was this run on SVB, which then just created stress in the market. So that's where we are today. There's a lot of craziness going on. I saw that the 10-year Treasury dropped by 50 basis points over the past few days as well. And a lot of different movement going on in the marketplace. And so that is why I asked Chris Litzler to come on and give us some insights. I want to know, Chris, what some of the conversations that you're having across the board are with lending institutions, with higher ups at Marcus & Millichap, with your clients like me, and what they're saying. What are the, and let's start with that. Let's start there, and then I have a bunch of other questions, man, we're going to dive into.
Yeah.
So,
yeah.
What are you seeing right now?
Sure. So couple things that we got to kind of just talk about first. So because we have to make a distinction between SVB and Signature Bank and many of the other banks that are out there. So you made a point about the FDIC limits of $250,000. And you also made a point that there was a big run on the bank. So you have $40 billion trying to be withdrawn in 3 hours because everybody can do it on their phone, right? This is unprecedented.
So it makes it even more likely of a bank run,
it's
right?
Unprecedented.
Yeah.
So SVB has all these deposits, right? And to your point, they're increasing. They need to put them out. Well, they did what the government basically told you to do 2 years ago, which is buy mortgage-backed securities. They're super liquid, like inflation's transitory, like you're going to be safe. And they buy 10-year paper at 1.5%. Well, when interest rates go up so quickly, those bonds aren't worth on the market today what you paid for them, right? They're worth 60-70% of face. So that's an issue, right?
Because let me just kind of break that down. If somebody goes and buys a bond today, they can get a 4%, 5% bond today. Right. So it's like, if I want the same return on my investment, I could just go buy a new bond, or I can buy Chris's bond at 1%, but I need a discount of 40%. So I might only give him $60,000 for his $100,000 bond at 1%, because then it yields the same return on investment as a 4 or 5% bond that I bought today. So hopefully that makes sense.
So what happened was they needed to liquidate some of those securities last week, kind of before this started to unravel. And
tech companies is who they banked. Obviously a lot of their valuations went down. They need some
And
extra
they
cash.
start withdrawing some money. Right. Exactly. Now, SVB classified, I'm going to get in some nerdy accounting here. They classified those assets as hold to maturity assets. So they don't need to mark them to market on their balance sheet. They can show them at cost because, look, we're going to hold these forever. Yeah, the yield's not great, but I'm not going to lose money. They're very safe, right? So we'll just, your GAAP lets you show those as at cost, not mark to market. Well, the second they had to sell them, right, they become mark to market and they take a $2 billion loss. And as soon as, somebody goes out and says, well, they just took this big loss, they're holding all these assets, like you might want to get your money out of the bank. Well, that creates a situation. The situation, though, is worse at this bank specifically because 97% of the deposits were uninsured. Because the nature of the customers at this bank, they're founders of tech companies, they're high net worth people, right? The bulk of the deposits are over 250,000. So naturally, those people get spooked, right? They want to withdraw their money and they want to buy treasuries, like very short duration treasuries, just to get them to just the safest asset that's out there. And that cycle that just went really quick. And no bank, it doesn't matter if it's JP Morgan Chase, no bank can tolerate a 25% withdrawal, right? They can't even tolerate a 10% withdrawal.
Right.
So you had this bank go down, and you had over the weekend everybody trying to withdraw their money out of Signature Bank. Signature Bank had 80% of their deposits uninsured. Okay. So it's natural to think, well, shit, I never really thought about this. Maybe I should be thinking about it. This could happen. I should move my money to short-term treasuries, or let me move my money to one of the systemically important banks, the big four banks, JP Morgan Chase, Citigroup, Bank of America, Morgan Stanley. Because the Fed has already said, they're systemically important. They're not going down. Like if I'm going to have more than 250 somewhere, it's moving to the big banks. Mm-hmm. So that's the key thing to think about when we're talking about this situation. It's why did this happen? And it's because the FDIC limit was low and they had a high percentage of uninsured deposits. So fast forward to last night, and the government is saying, you're going to get all of your money back, and we're going to put this facility up where these banks can come to the window and borrow money, and they can pledge these hold to maturity securities even at face, as opposed to mark to market. So if there is an issue, you guys can get your hands on this liquidity. So a couple things have happened since then, and you have a few banks that are kind of close in relation to SVB and Signature that are down pretty significantly today. Mm-hmm. Make your own inference on if something else is going to fall. I'm not going to name any names, but check the ticker, and you're going to see some big name banks getting smoked.
Yep. So all right. So we've talked about what that means.
Yep.
For people who have money in the bank, right? They said, hey, we're firing all the higher ups. We're going to look at the auditors who audited these companies and said that they were okay. And okay, well, like they're just trying to point the finger at somebody, right? And they're going to hire all new people. And I've already seen things like PNC potentially buying out SVB, or Chase Bank buying out SVB, and so other banks coming in and backing them. But it's a big acquisition, obviously, and a lot of localized deposits. So we know about what's going on with the depositors. We know about what's going on with like the employees and stuff at some of those banks. What does that mean? And we've talked a little bit about how that can systemically then expand, how it can, create a ripple effect across all these other potential banks that are related to those, and what does that look like, right? What does it look like for the individual? What does it look like for the business? What does it look like for the business owner who has stuff there? What does it look like for the employee who works for the business owner who banks there, right? Doesn't even realize where their paychecks are coming from. And it can create a spook, and I think, again, going back to the whole It's a Wonderful Life movie, is George Bailey, he solves a problem. He's like, listen, how much do you absolutely need right now, right? Because if everybody pulls all their money out, it's going to create a systemic issue, right? And so you can't be pulling all your cash out, because it's going to create an issue. It's going to create a bigger issue for you long term, and for everybody and the whole system, right? And so, like, don't go out and pull a bunch of your money out of the bank right now, guys. Like, it's a stupid move, because it can create a bigger issue. So we got to collaboratively look at this thing of what's best for the overall market. And it's to just sit still, sit tight, don't get spooked, and just cover your ass that way. You're much more protected by not touching that money than by going out and ripping all your deposits out of your bank account. So what is it? Go ahead. I'm sorry.
No, good. No, that's exactly right. The government needed to, and you saw it this morning, go out there and say your deposits are safe.
Mm-hmm.
Don't worry about it, right? Because if you could stop the runs, in theory, these banks actually are pretty well capitalized. Just nobody can deal with a run. It's not anybody's fault per se,
yeah,
right? But most of these banks are much better capitalized.
Yep. So what does it look like? Because some of the interest rates are dropping, right? The 12-month drop substantially, the 10-year drop substantially. Like, what does that mean for interest rates, right? What does it mean for the Feds raising interest rates? Like, what they've been talking about is how they're going to continue to raise interest rates over the course of the rest of this year. And now they're talking about not doing that at all, and potentially just letting it lie flat, or even drop rates now by the end of the year. What are you hearing on that front?
Yeah, that's exactly right. So there's two components. There's really two components of interest, or two parts of interest rates. There's a short end of the curve, right, which the Fed sort of controls, and then you get the long end of the curve, which is more dictated on economic growth. So the short term, let's call that Fed funds, right? That's the Fed funds rate, overnight borrowing rate. That's what the Fed sets. So you're at 450 today. Last week, you had an 80% probability of a 50 basis point increase next week. Okay. Today, you have in like a 550 terminal rate, or even higher terminal rate, 6% terminal rate. That's where they were going to stop hiking. Today, as of today, you have a 485 terminal rate.
Wow.
Which is really just pricing in one more 25-point increase total. Right? So it's a huge shift in sentiment from this move, right? Bank collapses are very deflationary, right? It's taking out jobs, taking money out of the system, like it's in nature deflationary. So if you have the bank collapse, you have inflation under control, you have this credit squeeze, right? You have like risk in the market. That's the job that's what they're trying to solve for, right? So why do I need to keep hiking?
Mm-hmm. Right. So it's naturally already occurring. Like, the Feds don't have to go out and use their tools to stop inflation. It's already happening in the market, and people are losing their jobs, and everything's slowing down, and there's less loans being made because banks don't want to give more loans right now because they need the liquidity. Like, what if this stuff happens? And then at the same time, people who need to refinance can't refinance because there's a lack of liquidity there. So it's like, it's already happening where things are, people are pumping the brakes.
At least with a lag, right? So there's at least you got an excuse for them to say, well, let's just wait and see, right? Let's just pause for a little while. So that's the short end, right? And then even a little bit longer than that is you got the 6 months into the 2-year treasuries, right? And what everybody is doing is they're taking their deposits that are yielding, depends, but usually pretty low, and they're popping them into 6-month treasuries or 2-year treasuries, with a 4 handle on them. And they're essentially risk-free. They're backed by the full faith and credit of the US government. So why wouldn't you do that? Right?
Yep.
So when all this money flows in, what does that do to price? Right? Price goes down, right? Because there's a lot of demand. So you have a flight to quality, which pushes down yields. So you've seen the 2-year go down 100 basis points in a week, right? And you've seen the 10-year come in 50-ish over the last, few days. So you got a sub 350 treasury. I guess I gotta look, but 345 10-year treasury. So what that says is, we think that there's going to be a problem, right? And we think that the forward inflation expectations are under control, and you have yields come down. So that's what's happening on kind of the curve, which is one component of commercial real estate interest rates. There's 2 components. You got the index, and you got the credit spread or the investment spread, right? So if there's no change in the credit markets and you have a decrease in the index, that's better for everybody. It's lower rates, right? Well, it doesn't really work like that, right? When rates come down this much, people think that there's risk, right? So we've already seen the agencies pop credit spreads like 15 basis points today. So you don't get that dollar for dollar, basis point for basis point decrease in rates, but overall, it's a move downward, right? Lower interest rates, obviously better for the real estate market, assuming the credit market doesn't get out of whack and spreads don't go crazy and lending standards don't go crazy and banks, go on the sidelines. So those are the 2 things from a rate standpoint. But so I think I know where you're going, but keep rolling.
Yeah. So the question becomes, if you got to go out and finance real estate, right, and finance your business right now, are you going to local banks, or if I'm going to finance real estate, agency lenders, which is Fannie Mae, Freddie Mac, are they still lending? Is CMBS still lending? Are life insurance companies still lending? Like, what do those options look like?
Yeah. So the answer is absolutely. Let's talk about apartments specifically, because I know that's your focus. So, CMBS, Lifeco, agency, all very active. In fact, the agencies are mandated to provide liquidity in this specific situation, right? That's what they're there for. So stabilized properties have, abundant financing options, right? The agencies are there, Fannie, Freddie, HUD's there. And that money is, all things equal, cheaper today than it was last week, right? So overall, it's a good thing. Nothing fundamentally has changed in your apartment building today from tomorrow, right? So, from a real estate standpoint, that's all good. However, a lot of times property doesn't qualify for agency. And what we've been doing for the last couple of, call it year or so, is we finance a lot of this stuff with banks and credit unions. Right. Well, we just talked about banks and credit unions, like that could be a little risky today, right?
Right.
So what we spent the morning doing is talking to all of our banking partners and seeing what's going on Main Street, right? We talk about what's going on Wall Street and in the Valley, but like what's going on in the Midwest in these banks? And I'll tell you, it's nothing. These
banks, they just
stopped.
They're just,
no, nothing's changed.
Oh, really?
Nothing's changed. They say our balance sheet is strong. We Chris, we're a little community bank, farmers bank here. We don't invest in mortgage-backed securities, right? We have cash, right? We got some shorter money, and we make whole loans. And oh, by the way, our insured deposit percentage, guess what do you think that is? A little
huge, because it's a community bank, so it's a bunch of people. It's a lot of deposits under 250.
97%, one guy told me today.
Completely opposite of SVB.
Completely opposite. What are the odds of that? So if your customer base is covered, why would they need to run on the bank? Their money's
Yeah.
secure.
Yeah.
And oh, by the way, they don't have the fundamental issues on the balance sheet with mark to market risk that a lot of these bigger banks do.
Mm.
So, fortunately for what we're seeing right now, no real fundamental change, from most of our banking partners. I mean, those are like, community banks, right? Now you are seeing some pressure on the regional bank index. I mean, it's down pretty significantly. But most of these groups are okay.
What about?
Now,
Oh, good.
there is risk that something fundamentally could change and everybody gets scared and you go, try to pull all your money, and that has a lot of risk. I mean, that would be terribly, terribly bad. But so far that's not what I'm hearing.
What's the feedback you're getting on like debt funds and who make a lot of the bridge loans and a lot of the construction loans out there? Like, what are they? Are they spooked?
Yeah. I think it's too soon to tell. I mean, I think that they borrow money on lines, right? And that those can get pulled depending on who's got exposure to what. So I think it's too soon to kind of see what the overall exposure is to some of these banks. But I think everybody's for now saying open for business, right?
What would you say is the biggest risk for real estate entrepreneurs, right? People that through our mastermind and through Commercial Empire and the coaching platform, and people that you bank. Like, where would you see the biggest risk happening right now for them? Or like, what's something that they just need to like, dude, make sure you're checking this out, make sure you're paying attention to this kind of a thing. Like, where do you see the pain points for them?
Yeah, look, the only time you really get into trouble is in a maturity situation, right? Like, if you got duration until your maturity event and the property's, generally performing, usually that doesn't make somebody go down, right? Now, if you got a floating rate mortgage and you don't have an interest rate cap and SOFR goes to 5 and that's a 4x increase in what your interest rate was, like, that can be an issue, right? Now, in that case, right, stabilize a property and you could refinance it, right? But where you get into trouble is in a maturity event. So let's say that somebody has a maturity looming. That's where you could get in trouble. So,
So would you say like, were you worried if it's less than 6 months out, or
I would start
12, 24 months out?
Yeah, I would start thinking about it. Well, hey, let's back up. I would refinance anything that is not permanently financed today as soon as humanly possible. So that means as soon as a property is stabilized, you should be looking at refinancing, whether that's 24 months before your maturity starts or 3 months before your maturity starts, before your maturity event is, get off the recourse, get off the floater. And, if your ultimate goal is to sell, is to hold the thing, then I would suggest you refinance it. Now, if you want to sell, I mean, I think you gotta be out way further in front of that because it's a longer lead time.
For somebody who wants to sell, say they want to sell next year, would you tell them as soon as stabilized, put it in the permanent financing that's fixed rate, and then just let the borrower or the buyer assume that current loan?
I think every situation is different. That could be a good avenue. Well,
I feel like it reduces the risk substantially because, hey, if I can't sell it, I'll just sit on it and I don't have that risk of having to try to refinance in 12 months from now.
Yeah, look, it depends on what type of loan you have in place today. If you got a floater, right, with some sort of looming maturity, then I would suggest you get off the floater. It's just a risk that you don't need in your business plan. But whether you put on long-term agency permanent financing or you just, refinance it with a more flexible prepayment with a bank or credit union, that's a business decision because the decision is, what do you think interest rates are going to be 12 months from now or whenever you go to you go to recapitalize this deal. Because
Yeah.
if you think that rates are going to go down, right, then you do not want to put on fixed rate money with, with call protection, because there's be a big prepayment penalty, and you're going to get less for it in the market because they could get better money if they brought fresh debt. Now,
Mhm.
if you think that interest rates are going to go up, then yes, that would be a good business plan to put fixed rate money on it.
So you're rolling the dice though, essentially, or if you think interest rates are going to go down, right, you're kind of rolling the dice of what's going to happen 6-12 months from now, saying, hey, maybe they won't hike more rates. Maybe we go into an election year next year and, they don't want to, hurt the economy. They want to stimulate the economy. Maybe they drop rates a little bit more. Is there a conversation about that?
Yeah, look, everything gets factored into there's a lot of discussion about rates, right? I mean, you could go a bunch of different ways. I think generally speaking, if you are purchasing a property today at today's prices, you must think that interest rates are going to go down, because you can't make enough yield based on in-place cash flow and the cost of money. So if you're paying today's prices, you must think that interest rates are going to go down, or you're accepting of a very marginal risk-adjusted yield, right? Now, if you bought this property a couple years ago, there's probably been a lot of appreciation. So the question is just, what does my partnership look like? Can we afford to hold this thing into perpetuity until such time as it makes more sense to sell, or do we take our chips today?
Yep. I love it, man. Dude, great insights. Really appreciate everything. Answer is, dude, stabilize your property, right? Just be a good business owner, stabilize your stuff, get it cash flowing positive, make sure that the income exceeds all the expenses and the debt service. And then you've got options. If the property cash flows, then you can refinance it at your basis, maybe refinance it, not so much right now above your basis, but doing cash out refis. But it gives you options, right? There's always going to be demand from buyers in that scenario. And I think it all comes, like, that's the conversation with my team.
Look,
get everything
it's exactly right.
Right?
You can only control what you can control, right? You can't control interest rates, you can't control capital markets, but you can control the performance of your property. So let's focus on that and, hope the rest works out.
Love it. Good stuff, brother. I appreciate you, man.
Anytime.
And let's see how things shake out over the course of this week. Maybe we'll jump on again. So appreciate you, brother.
Bye now.
See you, buddy.